How's it going, everybody? This is Spencer with Numbers Up Finance, and today we're going to be taking a look at RSI. RSI is a leading indicator for many traders. It is incredibly simple, and this is just going to be a beginner's guide to how to use it for your trading. So let's just start off by going over exactly what RSI is. RSI, which stands for Relative Strength Index, it is an oscillator that goes from 0 to 100, meaning that the RSI indicator is always going to be somewhere within that range. And to simplify it, it represents how oversold or overbought an asset is. The calculations for it are done comparing the average gain versus average loss in that asset for a specific time period. So you can see here I'm using the RSI 1470/30 close while there's no. Most of this is not that important. 14 means that it's calculated using 14 ticks, which right now we're on a weekly chart, so that represents 14 weeks. The 70 and the 30, the 70 is just my threshold for overbought, 30 is your threshold for oversold. That's all very subjective, and it depends what kind of trader you are. That's just the very standard, what most platforms come set up with. But let's get into a little bit more. RSI, like many indicators, is basically a representation of the momentum of a stock or an asset or an ETF or whatever it is you're trading. And so you can see here down at the bottom of the screen, this white line represents the RSI. This is the Thinkorswim platform. This is just SPX, so it's the S&P 500. But this chart goes back for a while, and normally people don't use RSI on a weekly chart. But this is just to set up how it looks and how it works. So you can see over here it goes from all the way at the bottom 30. SPX doesn't become very oversold on the weekly chart very often. All the way up to 90. Most assets you'll see won't be in such a tight range like this is here, but this is just a very broad market, so it's very non-volatile. But as you can see, so like say take this point here that I'm hovering over, this represents that the RSI for this specific period is about 30. It's very easy to read, it's not complicated at all. And so now I'm going to get into the basic purposes or the practical uses for RSI. So first we're going to take a look at TLT, and TLT is just it's an ETF of 20-year bond yields. So it's a very non-volatile asset, and we're looking at it at the 4-day chart. The reason for 4-day chart is just because it gives the most clear example of how RSI can be shown useful in the market. And so basically we come down to the RSI here, and this green line that I have drawn here, this is the 50 line. So the way that any oscillator works is the very middle represents like the average or the normalized area. And so the farther away that we get from this 50 line, the more extreme it gets, either towards when you go up towards 100, it becomes more overbought. And when you go down towards 0, it becomes more oversold. And the farther away you get, the more oversold it is. The farther away above you get from this 50 line, the more overbought it gets. And so these annotations on this chart, they're fairly straightforward, right? Any period that was a significant amount of time above this 50 line, I highlighted in a green box, so you can see we have the one here, and we have what looks like there could be another one coming up as we speak. And then the red ones are when it's below the 50 line. Here we have a significant period of a couple months below, a couple months below, a couple months below. And then you can see it correlates very well to how the price action of TLT actually moves. So we start off with this green box here. We see a very nice run up. As soon as it crosses over this 50 line, this 50 threshold right here, is right when the market starts to flip. Not the market, but the asset. That's what I meant. And then it crosses below this 50 line for a significant period of time. And as you can see, the price, a very bearish price action. And you can see the exact same thing for these two here. And now this is very hyperbolic how I'm explaining this. Most people don't use it like this. You can. You're more than willing to. My point in showing you this is just to give you a very simplified and dumbed down explanation of how RSI works. Okay, and so now we're going to get into some of the ways in which you can actually use it to actively trade. So this is a chart of the ES futures, which are the E-mini S&P 500. This is a daily chart, and it goes back a little bit more than a year or so. The first thing that I want to point out is these blue circles, these annotations that I have on the chart. So I keep my thresholds at 70 and 30 for overbought and oversold. And you can see that they act as a support and resistance likewise for the momentum of it, right? So you can see all these different times when it comes right down and it tags right off this line and bounces up. On the opposite side, it comes right up to this 70 resistance, and then the momentum shoots right back down. And it's not necessarily a buy or a sell signal. It's just something to keep in mind that oftentimes for these assets, they come to a certain level, and that level can act as a resistance or a support within the actual momentum. It's not taking into support and resistance on the price action of the chart, which is kind of unique. The second thing that I'd like to point out on this chart of ES is the extremes for RSI. A lot of times what will happen with RSI is it'll become extremely overbought, like you can see here, or it'll become extremely oversold, like you can see here. Both of these are not by themselves buy indicators or sell indicators, but they're very strong signals that the current trend will be changing at some point. Now, it doesn't necessarily mean that it's going to be a significant reversal or anything, but take for example here, we got incredibly overbought readings on the RSI, all the way up to 90, which is incredibly high for an index tracker. And the price is just shooting up right here. This is early February, late January of 2018. The price is just absolutely shooting up for an index. And as you can see, it plummeted right after, which is kind of natural. It's the principle of mean reversion. And so what that means is basically the price was significantly above the mean or the expected value, and the RSI showed that the momentum was incredibly overbought, and then it snapped back. Again, it's not a sell indicator or a buy indicator, but it's just a tool to have in your weaponry when you're trading. Likewise, you can see in these past couple months when we've had incredibly oversold indicators on the RSI, we've had small snapbacks. This one was actually pretty significant. This right here is about a 10% snapback. And again, it's hard to tell exactly when to buy in just using the RSI. Most traders use a slew of different tools and indicators and stuff that they use to determine when to buy and when to sell. But the RSI is just a very good indicator of where the momentum is at. And so, what else do I have? Okay, so the last thing that I really wanted to touch on this video is what are called divergences, and we'll post another video at some point about what divergences are, a more articulate and concise video on them. But the important thing to note is that it's a comparison between momentum and price action. And you get a divergence when the price action does not correlate directly with how the momentum is going. So an example using this chart, the red lines indicate bearish divergences. Now what that means is that the price is still going up, whereas the momentum is going down. As you can see that the highs are becoming lower. The momentum is starting to point down. In the case of, this is ES again, so the S&P mini, E-mini futures. As you can see, this bearish divergence played out beautifully in the past couple months. I was short for this time period, and it was very profitable because of that. Likewise, you can see right now that we actually have an incredibly strong bullish divergence. And so just to highlight what that means again, prices are making lower lows, whereas the momentum is pointing up. It's a divergence between momentum of the RSI, which is a momentum indicator, and the price itself. It's not buy signal exactly, but it's a strong indication that at some point in the near future, we're going to have a reversal or at least a rip up. And so, personally, I'm positioned long going forward for the next couple of days. It's a very short-term active trader mindset, but that's the kind of trader that I am, so you have to be able to make your own decisions. And then I'll just leave you on this with this video. So this is a mean reversion strategy algorithm, which it sounds very complicated, but it's not. It was made by Corey Hong, developed by Jacob Lauer, as you can see up here. And just to basically explain what this means, or to oversimplify it, this algorithm is run using RSI 2, which is, we discussed RSI 14. It's the exact same thing, just a different time period. But when the RSI indicated that an asset was overbought, that was a sell indicator. Once it hit 70, as you can see, that's the threshold for overbought. As soon as it gets overbought, you sell it. As soon as it hits oversold, which is 30, you buy it. It's incredibly simple. It's incredibly systematic. It's very straightforward if you actually practice this kind of trading. And as you can see, I backtested it all the way back to January 1st, 2003, all the way up to today's date. And this algorithm returned 1,304.96%. And to compare, SPY, which is the go-to benchmark for how the market is performing, returned a little bit under 300%. So if you use the most simple RSI strategy that you can over the course of time, it almost more than quadrupled the market returns, which is incredibly impressive, and it's incredibly profitable. And so I'm going to leave you there. Make sure you get your numbers up. If you like this video, make sure you like, subscribe, leave us a comment. Any criticism or compliments or anything that can help us out in the future is greatly appreciated.